All right, so let's take a look at this exercise here. It's a little bit long, analyzing unearned revenue changes. So one thing that we want to make sure we understand going into this, because this is extremely important, is that unearned revenue is not an income statement item at all. It is a liability. And it is most specifically or almost always a current liability. So this is a situation where when we have an unearned revenue liability, we're dealing with a situation where we have received consideration, usually in the form of money, but we have not earned that money, therefore it is unearned. So we don't have any revenue per se, because revenue is an income statement item. So again, very long and drawn out scenario here, and then we have about 3 questions at the end. However, only one of them involves calculations. So let's go ahead and look at this. Take-Two Interactive Software is a developer, marketer, publisher, and distributor of video game software and content to be played on a variety of platforms. There's an increasing demand for the ability to play these games in an online environment, and the company has developed this capability in many of its products. In addition, the company maintains servers or arranges for servers through a third party for the online activities of its customers. Take-Two considers that its products have multiple performance obligations. The first performance obligation is to provide the software to the customer that enables the customer to play the game offline or online. That performance obligation is fulfilled at the point at which the software is provided to the customer. All right. And then they play whenever they want after that. In addition, Take-Two's customers benefit from online functionality that is dependent on our online support services and/or additional free content updates. The second performance obligation is fulfilled over time. Okay, we want to underline that. That is important. And the estimated time period for which an average user plays the software is judged to be a faithful depiction of the fulfillment of this performance obligation. Okay, so a lot of information there, but what we want to recognize is that their first obligation is the customer pays and they provide the software at that time. So this is their first obligation, is just a normal sales transaction. However, as they when they buy that, a part of that cost is based upon providing online functionality, and that is, it's just like anything else that you can think of where you have some kind of a subscription to a service online, for example, and any upgrades that are made available during that subscription period are yours. So what this is saying essentially is that we haven't exactly earned all of this revenue in the very beginning, okay? And so without sticking too much into a bunch of unnecessary detail about the video game market, let's look at the financial information. It says at the beginning of the first quarter of the fiscal year, they had deferred net revenue liability, and see there it is, a liability of $566,141,000. When the quarter ended on June 30th, 2018, the deferred net revenue liability account was $466,429,000. Revenue for the quarter was $387,982. Okay, So we have some questions here, and two of them are going to be multiple choice, and one of them is going to be a calculation question. So it says here, what would have caused deferred net revenue liability to go down over the quarter? Okay, so and it did go down. There's no question about that. It went from 566 to 466. Well, this is a liability. So the only way to make a deferred revenue liability go down is to earn revenue at a faster pace than you incur additional liabilities or additional unearned revenue. So our answer, if we think about it, let's see here, is going to be this third one here. Take-Two must have recognized more in revenue than it sold during the quarter. And that will be our correct answer, because that is the only way that the unearned revenue would have gone down. We probably have some additional deferred revenue liability, but that was offset, the amount that we had in that was offset by the amount that was earned. So if you think about it, if you mow 2 lawns and you're owed, and you collect $100, $50 a lawn beforehand, you have $100 of unearned revenue, right? And so you earn that revenue at the point in time that you have mowed the lawns. Well, let's say that you mow those lawns and you earn that $100, but in the interim you collect another $50 in unearned revenue. Well, in that situation, you started off at $100 unearned, you end up at 50. So we're always getting some additional unearned revenue, okay? But in this case, over the quarter, there was about $100,000 more earned than we got in terms of unearned revenue. And so the third choice is correct. Let's see here. What was the amount of online-enabled games purchased by Take-Two's customers in the first quarter? Okay, well, all we have to do there is we're going to start with the amount of revenue that was earned, and this is the figure that would have shown up on the income statement. Okay, 387,982, and we're going to subtract from that the difference between these two figures here. Our starting unearned revenue of 566,141 minus our ending deferred revenue of 466,429. So let's bring the calculator over here and get this figure here first. 566,141 minus 466,429 equals 99,712. And so now we've got it made, right? So we're going to start over. 387,982 minus 99,712 gives us 288,270. So what we are saying is that we earned revenue of 387,982. We had additional unearned revenue of $288,270, and this obligation can only this amount can only become earned over a period of time, whatever that period of time is. We don't have that exact information. So going back to the lawn mowing example, we essentially we started off with $100 let's say we recognize $100 in revenue, and so in our case it was then $100 minus $100 starting unearned revenue minus the $50 for that third lawn, right? So in our little made-up example, it would have been 100 minus 50 gives us the $50 remaining. That's that third lawn that still hasn't been mowed, but we got the money for it in advance. Okay, so these numbers here are a little bit bigger, but 288, 270 is going to be our answer. And then finally here it says, were the purchases greater or less than the revenue recognized in the income statement? Well, 288, 270 are the purchases for which an unearned revenue liability exists. That's a smaller number than 387. So let's see here. This first answer here, purchases were less than the revenue recognized in the income statement. So hopefully the lawn mowing example helped. I don't know if it did or not, but one thing I do want to say about this word purchases here, that's not usually how we would use that word, but we're talking about customer purchases that triggered some level of unearned liability or unearned revenue liability. All right, that's it for this video.